Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
This weekend, we have many interesting topics to cover. The first is on the life insurance sector, where we will talk about the business models of insurance companies, how to value life insurance related companies, and what is the outlook for the life insurance sector. The second is investment gamification, where we will discover how game-like elements can revolutionize your investment strategies for you to make more returns. The third is a 401k webinar, where we will talk about how you can manage your wealth and make your wealth creation journey much more fruitful with your 401k. So, if you are interested in any of them, click on the link below to register.
In today's video, we're going to talk about a very important topic that is probably on every investor's mind. US recession. Should you worry? Now, August has been a very volatile month. You've already had a lot of headlines about the yen carry trade and how it's been unwinding. You've also had some fears about US recession because of a jobs report that came out towards the beginning of the month. And at the same time, you've also had very different opinions about what is happening in the US markets and whether that will spill over globally. So let's actually dive into this topic and understand what is going on. So to begin with, we have talked previously in many months about how global monetary policy is actually diverging because each central bank is now looking inwards domestically at their own challenges. So Japan, for example, is not particularly worried about inflation at the same level that the US is worried about inflation. So for them, they've only begun their rate hike journey now. The US is close to the peak of interest rate cycle. Doesn't mean that they are going to cut interest rates anytime soon. So if we look at how the chairman was talking about interest rates, they are ready to cut as early as September, but they have not committed to making any interest rate cuts. Any decisions on that will have to look at both inflation as well as unemployment together. So coming to the next stage, which is unemployment becoming a problem in the US? Is the job market actually weakening? So all of the headlines have basically been triggered by something known as the SAM rule. To put this simply, what it means is that when the 3-month average unemployment rate is 0.5% higher than the 12-month low. When this occurs, it is supposed to be a leading indicator of a recession. It has been pretty accurate from a historic perspective and has often been used to encourage early policy intervention in the labor market. So this breach happened for the last jobs report that came in. So there was some level of concern that the US has been tightening interest rates as well as monetary policy for a long time and has not been paying attention to the fact that the labor market is becoming weaker. But when we look at what is going on here, we will understand that essentially this increase in unemployment rate has not come because of an increase in layoffs. What this means is that more people are in the labor force now. So job growth has to be higher than before to maintain the same level of unemployment. So because of the increase in the number of available workers, you've had an increase in unemployment, not because of more layoffs. This is a very important distinction to make because this tells us that growth is still there and jobs are still growing. It's just not growing at the pace of new people entering the workforce. So the third thing that we're going to look at is the amount of money in the US markets. We will look at an indicator known as M2. Now M2 reached a peak in April 2022 and has fallen almost 3% from that level in June 2024. This is the biggest fall that you've seen in the last 90 years. So what this actually means is that the amount of money left for discretionary spending or speculative activities in the market is shrinking, because the rate of money growth or M2 growth in the US economy is actually slower than the rate of economic growth. So when this difference is there, you can see more market volatility, you can see a risk of trade happening. what is the conclusion that we can draw from all of these things that we have discussed in today's video? The first is, with respect to the yen carry trade, it's not all done yet. There can be more unwinding that comes up in coming weeks. The second is that the job situation in the US is actually not looking as bad as the headlines are. You can have a stronger economy, which means that the rate cuts also may not happen as early as investors are expecting it to happen. Investors have often been wrong in the rate cut expectations. We've seen that through 2024. We can also be wrong in terms of leading indicators, because for years together now people have talked about an inverted yield curve in the US, where the 2-year treasury is trading higher than the 10-year treasury. So leading indicators, while they may have been accurate historically, need not necessarily be showing us the same picture today. The third important thing is that because of the money conditions in the world, as well as all of these factors and the level of uncertainty that is there at a geopolitical level, markets can be quite volatile going forward. Knowing that this is the case, we should be prepared to deal with market volatility, and that is the most important decision you need to make today. How will you combat volatility? Let us know in the comments below.